Okay, there we go. All right, so welcome everyone to my 100-day challenge. And tonight we are going to be talking about, well, I won't be talking about Shaquanna Brooks, Brooks Alliance. She's a CPA. So if you ever hear me talking about when you want to work with the accountant, you want to work with the CPA. CPA stands for Certified Public Accountant. So that means she's licensed. She knows what she's doing. She can make recommendations. So, you know, she's a little different than working with like your HR block or anything like that. So she actually used to work with what was the major CPA firm?
Oh yeah, I worked at one of the top 4 accounting firms.
Oh my goodness.
PwC.
PwC. I wanted to make sure I said the right one because I was about to say EY, and I said it's not EY. So she worked with PwC, worked at PwC, which is a very large accounting firm, and it's actually not a lot of Black CPAs. So she's one of the very few, and it's not a lot of Black female CPAs. So y'all are in good hands when it comes to saving on your taxes, which is crucial, and it's still time to do it. So I'm going to pass the baton over to Shaquanna so that she can be the host, and then that way you can share your screen if you need to.
Yes, I do need to share my screen. Thank you so much. Thank you for having me. Thank you for sharing your community with me. You guys are locked in for 100 days. Like, what day is this?
Oh gosh, today is it's week 7.
It's week 7. Okay, so how many weeks do you guys have?
We have 14 weeks, so we halfway through.
Oh, so it's in the halfway mark.
So
and so they go through, and then they should have all the skills and all the resources and understanding, so therefore they can invest.
Yeah, and also wanted to bring you on too because it's end of the year, so there's still some opportunities to save on taxes, and especially, and I also get a lot of questions too about investing in real estate. They're like, okay, should I invest as a business? Should I invest as a personal? And I'm like, okay, you need to ask your CPA. So I was like, well, let me go ahead and bring a CPA on, because a lot of people don't have CPAs, or they try to do it themselves, and they get with the complexities, and especially if they get K1s and they don't understand what to do with it, they don't understand how to invest, and also the benefits of having investing in real estate to save on taxes.
So that's what we will be going over today. Okay, perfect. All right, so I am going to just spotlight myself for everyone. So hello everyone, how are you guys? Definitely give me 1 second so therefore I can share my screen.
Oh, wait a minute, I didn't press record. Hold on.
No, I think you did.
I did. Okay, that's weird. Okay,
check it.
No, it's recording.
Actually, recording. Is it recording for you? Are you sure?
Wait, let me check.
Okay, make sure. Because nothing worse than a lesson.
Okay, it's recording. Yeah, I would say I can't make this one up. Okay. Okay.
All right, perfect. All right, so let me go ahead and share my screen. Sharing is not turned on. A host isn't allowing multiple presenters sharing for this meeting. Can you turn on my sharing, please?
Oh, wait, I thought I made you the host. There we go.
All right, perfect.
Okay, here we go. You good now?
I'm good. Oh, yes, I'm good. I am good. All right, let me just share my screen. I'm excited. I love anytime I get to talk real estate. Okay, so let me know who's in the room. If you have seen me speak before, drop a 1. If you have not seen me speak before, drop a 2. Just definitely want to know who is in the room, so I can know if you guys see me. Oh, hi, Jamita. Hi, Belinda. Okay, so they have seen me speak, so I love that. So definitely looking for, I guess everyone else has not seen me speak before. All right, guys. So the good thing tonight is that I always am talking about tax strategies for business owners. But tonight I'm going to get to talk about real estate. And I love real estate. Real estate is my thing. It is my jam. I love real estate. So we are going to talk about tax strategies for real estate investors. But I know that you guys are looking to invest together, right? So you guys need to understand, what does that look like if you receive a K1? If you invest in a real estate project and you receive a K1, what happens on the back end? And then what does that really mean for you on the front end, right? Meaning when you file your taxes. So we are going to go through this and So therefore, you guys can understand what is the benefit of investing in real estate. So before I get started, I know some people said that they have seen me speak before, but there are people here that have not seen me speak before. So I just want to introduce myself. My name is Shaquanna Brooks. I go by Miss Business across all social platforms. I'm also known as Queen of the Tax Code. I am the CEO and founder of Brooks Alliance. Brooks Alliance is a tax and accounting company, which I started back in 2017 while I was still at the accounting firm. I pretty much had to make a decision on if I was going to stay in corporate or if I was going to start my own firm. And I decided to start my own firm because I seen that there was an issue. And the issue was that there were too many people that were strictly focused on how to make money, but no one was really, really focused on how to actually save it. And I knew that we were in big trouble because I grew up in a small business. So I grew up in a small business. I'm from New York. Anybody here from New York? Let me know in the comments. But I'm here. I was born and raised in Brooklyn, New York, and my dad had restaurants where I worked. I started working at the age of 6. So daddy's girl wanted to be around my dad. So I started working very early. By the time I was 15, I was already running and operating his businesses. My dad started out renting a space, and now he owns half of the block. So it has been an amazing journey because throughout his business journey, I have not only been able to see him operate businesses, sell businesses, close businesses, open, hire, fire, deal with vendors, deal with accountants. But I also have been able to see him acquire the buildings that he actually was operating in, which a lot of times you don't see people do that, right? Most people are renting. And obviously, if that's what you have to do initially, how he did, but seeing him actually acquire his building was definitely major for me. So for me, that I feel like I fell in love with real estate very, very young. And so I got to a point where I was working in my dad's restaurant. By 15, I was running his restaurants while throughout college, when I was not in school, I would be working at his restaurants up until I was about 23 or 24. I worked in my dad's restaurants, obviously having the capabilities to run the restaurant. And then I left and I went corporate. So I went corporate because I wanted to understand what were these corporations doing to make these big trades? What were these corporations doing to build these big buildings? What did that look like? And specifically the big buildings. That was really, really important to me. So I went in the accounting firm and I said, okay, well, I'm here. I want to work in financial services. They put me on mutual funds. Which was, for those of you who do not know, mutual funds is the investment vehicle for 401ks. So I was completely bored. So a few years into my career, I switched over to real estate private equity, where I stayed there for 4.5 years. It was amazing. I loved it. I loved everything about it. So I worked on some real estate private equity deals relating to like really big skyscrapers that were being built in the city, all the way to working on REITs. So I have a very wide range of experience as it relates to just understanding taxes, understanding accounting, understanding real estate. Because that is my background. So, that's me. And then I had to start my firm. And when I started my firm, as I mentioned, I knew we were in trouble. And so Brooks Alliance pretty much services small business owners, real estate investors, contractors, freelancers, just helping you all navigate the tax side of things, right? Because so often you're always, the communication is going to heavily be around, how can I teach you how to make money? Everybody wants to teach you all how to make money, but if you're not careful, you're not strategic enough, you literally can give 50% or more of your money away, right? And that's not what we are here to do. We are here to strategize, switch some things up, so therefore we can proactively approach our taxes the same way that corporations do. So that is who I am. That is my why. That is a little bit of background about me, just to talk about my accolades. So I have been a guest on EYL. I was actually their first guest. They are actually my clients. So being able to, be their accountant and see them, through from the beginning has been amazing. I have been up on Way Up with Angela Yee. I am a CPA contributor to Good Day LA. I have I'm one of the top top CPAs with ADP. I've done multiple partnerships with QuickBooks. Melanin Money, for those of you who are familiar with Carter and George, my firm, Brooks Alliance, is the accounting firm that does all of the tax strategies and tax planning. So we do a lot of background work. I do a lot of work in the background. That's honestly where I love it at. But Miss Business, I guess, had my own purpose there, but I really do thrive in the background. I love it. But nonetheless, just being able to make a decision and bet on myself and start my firm and teach about accounting and taxes when no one else was talking about taxes really has paved a way for me, and I absolutely love it. I don't know if you would find someone more passionate about helping you all save on taxes, but then also being able to not only educate you, but also provide you with a firm so therefore you can implement, right? Because a lot of times, people are telling you all these amazing things that you can do, but like, okay, who's going to actually implement it, right? And so that's where I come in at. So that is a little bit about me. So guys, if you guys are ready, put ready in the chat. Let me know that you guys are ready. Let me know you're here with me. So therefore I can, know. All right. I'm seeing Jamita said ready. Let me know in the chat if you guys are ready. Want to just, before we proceed, I want you all to understand the big difference between what you may be used to in terms of the communication and then what you're going to hear tonight, and why the communication is so much different. And the communication is so much different because most times most people are used to operating and communicating and working with tax preparers. So a tax preparer is someone that they're going to prepare your taxes. They literally only can be found January through April. They're going to give you very limited advice in terms of how to change your tax situation. It is more so, hey, give me your documents. Here's how much you owe. Here's how much, here's your refund. No real communication, right? You have no idea. They probably have no idea. And that is, pretty much how that goes. A tax strategist, and that's what I am, a tax strategist is going to analyze different tax scenarios to help you determine the best tax strategy. Right? So that could be taking advantage of tax credits, tax deductions, timing differences, just certain investments. So sometimes you guys will see at the end of the year, you'll notice that people are like purchasing more homes, or they are purchasing more vehicles, or it just seems like they're splurging a little bit more. And it's not because they want to, but it comes down to, listen, am I going to spend my money, or am I going to give my money to the IRS, right? And so that is the approach that we have to take. But the only way that we can take that approach is if we are is if we are approaching taxes from a space of saying, okay, well, I'm going to tax plan, right? So one thing I want us to understand before we move forward is that our mindset is now shifted. Now that you are in this class, now that you have been exposed to me, your mindset is now towards tax planning, okay? So tax planning just means that whatever we need to do to save on taxes, we're going to get it done before December 31st. And why? The reason why we do that is because we file our taxes retrospectively, right? We don't file our 2024 taxes until 2025. So because we file our taxes retrospectively, we can't wait until January through April. That is tax paying season. Okay? We have to file our taxes we have to approach our taxes and analyze our tax liability during tax planning season, which is July through December. That's when you sit down and you say, listen, I owe the IRS this. It looks like this is what I'm going to owe them. I don't want to owe them. What do I need to change? What facts do I need to change? So therefore, I'm able to now change my situation. Okay, that's how that works. So are we clear on that, guys? Are we clear? I'm going to just grab some water. Just let me know. I require some interaction in the comments. I need to just make sure you guys are with me. All right, perfect. And I will hold all questions until the end. So if you guys do have any questions, I'll open it up for some Q&A at the end. It's just that when I'm teaching, I can't really look at the chat too much. All right. So one thing that I love to break down, so it drives my point home, as it relates to just the mindset of taxes, it's just understanding different quadrants. So I love this quadrant. This is Robert Kiyosaki's quadrant, his cash flow quadrant, but it helps me break down taxes as well. And the reason why this is so helpful as it relates to taxes is because I need you all to understand that, one, you guys are in the best position, okay? The best position because you are looking to invest in real estate. So one thing that I want to do is just talk to you all just about what it means as you flow through these different brackets, and what does it mean from a tax perspective. Before I go through that, one thing I want to let you all know is the more you work, the more taxes you pay. Okay? You cannot work hard and want to pay less taxes. It doesn't work like that. The tax code is made for business owners and investors. Who has W-2 income here? Anyone have W-2 income? The tax code is made for business owners. So Tommy said me. So let me know in the chat, guys. Crystal said me. So the more you work, guys, the higher your taxes. And what I mean by that is, if you are W-2, what happens? You have a set amount of money, right, that you get paid. Your tax, whatever you get paid, falls within a certain tax bracket. Your tax, right, and then you pay your bills and what's left. That's pretty much how it works. There isn't much wiggle room, right, and much things that you can do to actually change your tax situation. It's pretty much set in stone. So one thing that I also want to talk about are tax brackets, because once I get to being an investor, you guys will understand what I mean by the tax brackets. As an employee, as a business owner, your tax bracket ranges from 10% to up to 37%, and that is only on the federal side. State side, you could be looking at an additional 8%. If you live like me in New York City, you also have a local tax as well, right? So that could take you to a whole an additional 12% in taxes. If you're not careful, you literally could be paying out 50% or more in taxes, right? Just like that. So when you become self-employed, what happens is you now give yourself a job, right? You say, hey, I want a business. This is what I want to do. Then what happens is now you're able to dip into, you're able to take advantage of the tax code a little bit more. You're able to utilize deductions. You're able to make it work for you because now it's a situation where you are able to take advantage of the tax code. So what happens is your tax bracket is still the same from 10 to 37%, but what happens is that you have more flexibility. Okay, so you have more flexibility. Then what happens, right? You then become a business owner. You have people that's working for you. And this isn't everyone's path, but this is my path, right? But I'll talk about that in a moment. Then you become a business owner, meaning that now you have employees. You're now able to leverage. You're now able to incentivize your employees more, which are tax deductions, which then in turn does what? It lowers your tax liability. Right now, you're really able to tap into the tax code and really be able to have it benefit you. Then you move into becoming an investor. And let me tell you, this is why I say you guys are in the best position, because you guys there are a good amount of people here that said that they are an employee. So if you are an employee, you're going straight from E to I. Okay, some people are going to go from E to S to B to I. That's where I am. Because no matter what, You have to become an investor if you want to save on taxes. There will become a time, as even if you're a business owner, that there will be nothing else that you could spend money on to increase your tax deductions. It just is what it is. And so, and if you want to really save on taxes, you have to become an investor. And why that is so important is because, remember, I talked about that tax bracket. Your tax bracket as an investor ranges from 0% to 20%. So I told you guys, the more you work, the higher taxes you pay. And this is proof in that. As an investor, you have passive income. The highest tax rate that you are going to see is 20%. So I use this example all the time. I have a married couple. They make $90,000 a year. They file married filing joint. They're looking at about 15, let's say 15%. Let's just say collectively, they're looking at about 22 to 25%, right? Between federal, state, local, depending on where they live. If that same couple invested in real estate, purchased a piece of real estate and sold that real estate, guess how much taxes they would owe if they sold it at a profit of $90,000? Zero. They would owe zero, because in the tax bracket from $0 to $94,000, you pay zero taxes if you file married filing joint. And I want you all to understand that before we proceed and before we start talking about, hey, these are all of the tax strategies that people take advantage of, the why people get into real estate. Yes, I love real estate. I'm a lover of real estate. But the reality is, real estate is going to cash flow for you. Yes. Real estate is going to appreciate for you. Yes. But real estate is also going to provide you amazing tax deductions. And so when people are making decisions, and even when you are a business owner, eventually you have to get to that space where you start to invest in real estate. It is that simple. Okay. So I wanted to break that down for you guys, because I want you all to understand that, one, you are in the right place because you get to go from E to I, right? I had to go from E to S to B to I. And again, as I mentioned, it doesn't matter. You're going to get to a point where you have no more tax deductions in your business. The only way you're really going to start saving is if you become a real estate investor. So let's talk about it. The simplest way for me to talk to you all about this is just to break down and give an avatar and break down, what does this whole scenario look like? What happens on the back end? So let's just go through it. Let's talk it out. Remember, hold your questions until the end, and I will open it up for Q&A. So we have Ashley. Ashley is 29. She lives in New York City. Her career is sales. She makes $80,000 a year, and she has tax due of $32,000, right? So she has tax due of $32,000. Ashley is taking home $48,000. Ashley's like, no, I'm tired. I am tired of giving my money away to the IRS. I done sat through one of Ms. Business classes, and she told me that if I invest in real estate, then I should be able to utilize the tax code to my advantage. So that's what Ashley decided to do, right? So Ashley decided to invest in a real estate fund, right? Take her money and invest it in a property that had a value of $500,000. Right, so she invested in a property that had $500,000. There was rental income of $20,000. All right, so what happens is, sorry, let me just move that. My picture is on this screen. Let me just move. Okay. So what happens, and just to take a step back, what happens when you invest in real estate is a business. So that's the amazing part, is because when you are investing in real estate, right, you guys go and you say, hey, we're going to invest, and we're going to purchase property, or we're going to invest in a fund. We're going to, however you decide to pull your money together to invest in real estate. What happens is that real estate has two amazing sides. It has the business side, which allows you to deduct all of your expenses. So the IRS just says, listen, as long as an expense is deemed reasonable and necessary, you can write it off. right? As long as it falls into those two categories, then you can write it off. But it also has the asset of real estate. So what happens is you get to take the total tax deduction, right? You get to take the total tax deduction of $23,000, right? But what exactly is that? What happens is when you invest in a piece of property, you have to account for the revenue, right? That you're bringing in, that rental income that you're bringing in. But you also get to invest in you also get to deduct all of the expenses. So any education, any mentorship, any masterminds, any research, any legal and accounting fees, property taxes, mortgage insurance, property insurance, utilities, repairs, maintenance, advertising, travel expenses, meals and entertainment, like you name it, you get to take the deduction. Okay, so I want you all to just understand that you're in a beautiful place because you get to take both sides. But Ashley invested in a fund. So Ashley really just put up her money. Ashley's like me. I want to put up my money and I want somebody to do it for me, right? I just want to reap the tax benefits of these things later on down the line. So Ashley said, listen, I'm going to go ahead and I'm going to give this money up for this property. And when I give this money up for the property, what happens is on the property side, these are all of the deductions that Ashley is going to be able to take. What other thing that Ashley gets to take advantage of, as I mentioned, real estate has the beauty of having an asset backing it as well. So anytime you have an asset, you get to take depreciation. So all depreciation is, guys, depreciation is the process of deducting the value of an asset. Okay, so that is pretty much what depreciation is. And so with depreciation, you can deduct, and it really depends. So you have different depreciation values. If it's residential, it's 27.5 years. If it's commercial, so those of you like looking to get into a hotel, then that depreciation would be over 39 years. So it depends. Every asset is different. All asset classes are not divided over the same amount of time, which we will go into further in a moment. So the depreciation expense that Ashley will be able to take advantage of on this property will be $13,454. Okay, so on top of the $23,000 that I just told you guys about, Ashley's also going to be able to have her depreciation expense. Now, what does that do? If I go back, I told you that there was rental income of $20,000 and she had deductions of $23,000. It's her first year, so the expenses are a little higher. Then she also had some depreciation expense of $13,000. What does that do? Well, what that does is that's going to allow Ashley to be able to invest in real estate tax-free. And that's what I call being able to win in real life and lose on paper. Meaning in real life, Ashley is most likely really seeing a profit. But on paper, Ashley's going to be reporting a loss due to depreciation. Because depreciation is not real, guys. It doesn't matter if you purchase your property and you put out for the year $10. You can still depreciate this $13,454. And you know why? Because it's based on the value of the asset, not how much money you actually, how much money you actually put out. Okay, so that is an amazing thing. So what I just showed you guys was, okay, Ashley could win in real life, lose on paper, and that's great. But what I want to do is show you and take it a step further to show you why wealthy people and why all these other people are really in a position where they are investing in real estate and how they're utilizing it. And even some of my clients have literally used real estate to wipe out hundreds of thousands of dollars that they have received in business profits. Okay, so I want to introduce you all to what's called cost segregation and bonus depreciation. So cost segregation, all cost segregation is, before I even get into what cost segregation is, one thing that I want to tell you is a building, the IRS, I just told you guys here that the IRS says a building can be depreciated over 27.5 years. But what we know is that a property is made up of more than just the building, right? A property is made up of various different aspects of the building. And I also mentioned to you guys that the IRS gives every single asset class a different useful life, meaning that some assets can be written off over 5 years, some over 15, some over 7, some over 27 and a half, some over 39. So it all just depends. It's very detailed out. There is no guesswork. If you have an asset class, the IRS will tell you how long they think that the useful life for that asset is. So what happens is when, as advisors, and this was one push for me as when I was in corporate, and I realized like how like small business owners and investors, it's not that they don't want to do better. It's not that they want to overpay the IRS. It's that they just don't have the professionals to really like strategically approach their taxes for them. And so that's why it was so important for me to start my firm and really position my firm in a way where I could be that for small business owners and real estate investors, because I noticed that all year round when I was in corporate, that's all we focused on taxes all year round. There were different professionals and advisors coming in and telling us, hey, these are the things that we need to be focused on. And we had that, right? And so I realized that this is not just about money or having access to advisors. It's just as simple as having that person that's going to really say, hey, this is how we need to be doing things. This is how we take things a step further. Because who would have been okay with this, right? I could have came on here and said, listen, if you want to be able to invest in real estate, get an asset, have the appreciation, you may have some cash flow relating to it. Because of depreciation, you'll be able to live tax-free with that revenue. That's fine, right? You would be able to invest in real estate tax-free. But what I want to show you is I want to take it a step further. And we're going to take it a step further with cost segregation and bonus depreciation. So cost segregation, it pretty much is the study, right? It's pretty much a study, and it's a process that looks at each element of the property. So because each asset has a different useful life, what happens is that we need to go in and we need to dissect this property. I'm not allowing the IRS just to divide my property over 27 and a half years, because why would I want them to do that? If I don't have to, I want to be able to reduce my years, right? That I'm dividing it over. Why? Because that allows me a bigger depreciation expense. And the idea, especially when we have income that we need to offset, the idea is that we want to make sure that we are accelerating as much depreciation as we need to. So basically, we'll perform a cost segregation analysis, pretty much analyzing and splitting up the asset into different categories and looking at the asset in each category, which it'll be much clearer what I'm saying on the next slide. But not only are we going to implement cost segregation, we're also going to implement bonus depreciation. So bonus depreciation is so important because when you have an asset like a building you cannot take bonus depreciation on, but other asset classes you can. So how can we strategically break our property down so therefore we're able to take accelerated depreciation, so therefore we can have a higher depreciation expense? So guys, all bonus depreciation is accelerating your depreciation, being able to write off your depreciation faster. And it's amazing because, as I mentioned, with a property, you can't do accelerated depreciation. But something like personal property, or let's say you had a laptop or you had an HVAC in your property, you can accelerate that depreciation, which means that you can take more of it. So up until 2022, you could have taken up to 100%. What happened is after 2022, this bonus depreciation tax code is now starting to phase out. So every year it goes down by 20%. So if you're new to this, then what happens is, you're late, but you didn't miss the boat totally. So in 2024, you can take 60%, because in 2022, you could take 100%, 2023, you can take 80%, 2024, you can take 60, 2025, you'll do 40, then 20, then it'll totally phase out in 2027. So depending on who our president is going to be within the next few days, that will heavily depend on if they will renew this or if they will not renew it. There has been talks about renewing this. Obviously, under Trump administration was the ones who actually implemented this. So there has been talks, you know, for obvious reasons, right? He's in real estate. His buddies are in real estate. Everyone has someone that they have to appease to. So this may be something that they may renew. And that's another thing that I want you all to think about, and I want you all to look at and pay attention to. You have to pay attention to who your presidents are. If you notice, Kamala and Trump has been doing what? Throwing out tax benefits, right? And why? Because they know anytime they want us to do something, vote for them, get in an electric vehicle, invest in real estate, start a business, they are going to allow us to keep more of our money. They know what the people want. So therefore, what I want you all to do, and what I encourage you all to do, in order to win at this tax game, you have to pay attention to your candidates. You have to pay attention to who's going to be your president. Every person has someone that they have to appease. And once they are there, it really just is what it is, right? So it's your duty to say, okay, well, I know if, and I'll just give an example. I know that if, and I'll just use this, I'll just stay on this. I know that if Trump goes in, I'm going to be on the lookout to see if he extends the bonus depreciation tax code. Okay, why? Because now that allows me to take more bonus depreciation. Now, if Kamala wins, you have to look out for, what was her thing as it relates to capital gains? Oh, she wants to tax people on capital, unrealized capital gains taxes. Right? So that's huge. That is major. That is saying you're investing in a real estate and you're investing in an asset. So whether that's stocks, whether that's real estate, whatever it is, what she's saying is, hey, you can invest, but as this asset is gaining value, you will have to file taxes on it. Right? And so that is very important. You have to pay attention, because when your eyes are open, what it does is it allows you to strategically approach your taxes. And that's where I don't know if you guys hear the passion in my voice. I'm very passionate about it. I want you all to strategically approach your taxes, because you're giving away an additional 20, 30, 40% sometime in taxes. And the reality is you're just giving it away, but you're giving it away because you're afraid of the IRS and you don't understand the tax code and you don't understand what's available to you. But you have to take it, I always say, like, you have to take it as offensive. Like if I walked up to you and said, give me 40% of your business, give me 40% of your property, give it to me right now. Every single year, I want 40%. You would want to fight me. You would be offended. You would feel like, what gives you the right to take 40% of my money? So I want you all to have the same mindset as it relates to real estate. You have to think, as it relates to your finances, you have to take it personally. Like, I need to do whatever it is that I need to do. Will you have to pay taxes? Absolutely. I'm not here telling you will not have to pay taxes. But what I'm saying is that you can strategically lower your taxes, right, based on utilizing the tax code. And one thing that I want to point out to you all is that the tax code is made up of 77,000 pages. Okay? 99% is telling you how not to pay taxes, and 1% of it is telling you how you have to pay taxes. And so if you needed any indication that there are strategies and there's things that you can do to implement, here's your sign. 99% is telling you how not to pay taxes. All right. So let's just talk about this property, right? Because I told you guys, we got a depreciation expense of $13,000, which was good. It was a good, it was good. But what I didn't tell you guys, right? And what we didn't get into yet is cost segregation with bonus depreciation. And so what does that mean, right? So we're breaking up the property, and where we can, we are accelerating the depreciation, so therefore we can have a bigger depreciation expense in that year, okay? So same property, $500,000. You have land on that property worth $130,000. No, land cannot be depreciated, okay? So what happens is the building is not worth, right? The building is only worth $250,000. So if the building is worth $250,000, you have personal property worth $87,000, you have land improvements worth $25,000. And what happens is what happens with a building? I told you guys, you cannot take bonus depreciation with the building. So you have $250,000. You're going to divide that over 27 and a half years, which is going to be $9,382. If it was a hotel or any other commercial space, it would be divided over 39 years, okay? So now you have a depreciation expense of $9,382. Your personal property can be depreciated. Some is 5 years, some is 7 years, depending on the type of personal property. But I would just say, let's just say 5 years. You get a depreciation expense of $52,200, right? And keep in mind, right, it's not the whole 100%, it's only 60%. Because I explained to you guys that you cannot take 100% anymore, you only can take 60%. So with personal property, what happens is you will take the 60% of the $87,000. Land improvements, $25,000. 60% of that is $15,000. So you will have a total depreciation expense for the same property I just told you got a $13,000 depreciation expense for. You will get a $76,582 depreciation expense. Now, what happens? What happens in terms of, and actually give me 1 second. Let me just give me 1 second. Because I want to I need to adjust. I need to adjust something. All right, much better. Okay. Let's go back. Okay, so let's just talk about Ashley, right? So I told you Ashley had she had the W-2 income. Ashley also had, oh, I'm sorry, let me just remove this because I need this to let me just remove this. Oh, no, 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 no. I'm like deleting stuff I shouldn't delete. Because I had this example originally with Ashley just having income versus Ashley having a K1, but I know a lot of you are going to receive K1s from your investment. So I wanted to just talk to you guys about what that looked like if you had a K1, okay? So that's why I am updating these numbers. All right. So guys, Ashley had W-2 income. Ashley would have received a K1 with her rental loss of $70,582, right? Because basically what this consists of is I told you guys originally Ashley had $20,000 in rental income. Then Ashley had total tax deductions of $23,000. And then I told you that Ashley got a depreciation expense of $76,000, right? So basically that gave Ashley a loss of $70,582. What that would have done is taken Ashley taxable income to $428. Now, there are going to be people here that are going to be like, oh, well, what if I want to invest in real estate? Or, the good thing is when you want to invest in real estate, and actually, let me just go through this and then I'll talk about that. So this brought Ashley taxable income to $428, which would have given Ashley a refund of $30,000. Right, so all the whole $30,000, basically almost the whole $30,000 that Ashley paid, Ashley would have received back. And so this is an example of how people have business income, They may utilize their real estate to offset their W-2 income. Now, it's very important, right, to understand how these things work and how to utilize it to your advantage. How do you make this work? So this is like a prime example, and this is like the easiest way for me to like get my message across to you guys in such a short period of time. But I want you all to understand that when you invest in real estate is such a powerful tool. But one thing that I want to just talk about really quickly, because I know that there's always the question of, hey, do I invest in real estate through my name? Do I invest in real estate through a business? Do I invest in real estate through a fund? So I want to just talk to you guys about what that looks like, right? So when you are investing in real estate, let's say you are investing in real estate by yourself. You are not investing in real estate through a fund. What happens is, and you're investing using your name or an LLC, what happens is you file Form 1040. And if you have W-2 income or any other income, obviously that is there. But then what also happens is that if you have your Schedule E, then that's where you would report all of your rents and all of your expenses and your depreciation expense. And then whatever that loss would then be carried over. Now, that's very different if you invest utilizing a fund, right? So when it comes to a fund, what happens is when it comes to a fund, you will receive a K-1, or if you're investing with a group of people, right, you're either starting an LLC or a partnership of some kind. And what happens when you file taxes utilizing a partnership, the partnership files tax form 1065. Tax form 1065 will then say, hey, these are all of the owners, and all of the owners will then be will receive a K-1 with all of the profits distributed, right? So that is pretty much how that works. So as an example, let's say we have 6 owners inside of a partnership, and every owner put up $10,000. And let's just say hypothetically that gave every person, let's make it even. Let's say there's 10 owners, so everybody has 10% in the company. And let's say the profit, or let's just say the loss in the company was $100,000. What happens is that you will be able, as the owner, you will receive a K-1 that has a loss of $10,000 on it, that you would then report in your personal taxes. So no matter if you are investing in real estate personally, right, you will need to file 1040 in Schedule E. If you are investing through a partnership, then what happens is that you are going to still need to include that K-1 in your personal taxes. Now, there's always a question of, hey, well, should I invest utilizing a business, or should I invest utilizing a business, or should I invest utilizing, my personal name? It doesn't matter from a tax perspective. I will tell you that. It does not matter. When it matters is more so from a legal perspective. If you want to separate out your business if you want to separate it out from more so from like a legal perspective, then that's when you can consider it. But in terms of the the tax legal ramifications, the limitations, what you're allowed, all of those things are the same, whether you file under your personal or whether you file under your business. What I will say is it makes it a lot easier when you are filing under your business if you need to change anything in the future. And what I mean by that is, let's just say hypothetically, let's say you have business income and you need that real estate loss to then offset that business income. What happens is that you can literally say, all right, well, that's already all in one business. It can nicely offset it underneath this one business. But guess what? It'll still offset it. It just will offset it in 2 different line items versus it offsetting it all underneath one business. So again, does it matter from a tax perspective? No, sometimes things does matter from a tax perspective. But when it comes to investing in real estate and the limitations and things, it's the same exact thing, no matter if it's a business or if it is personal. All right. So I tried to get through that as quick as possible. I hope that everything that I mentioned and I talked about actually makes sense. I do want to open it up for Q&A. So if you guys have some questions for me, let's talk about it. Let's talk about, you can just raise your hand. Thank you so much for educating us. You're welcome. You guys are welcome. I just want to make sure that you guys really, really understand like the benefit as it relates to real estate, because sometimes we see people doing things and we don't understand why they're doing it. Why are so many people in real estate? Is it really because real estate is just this great? Real estate is great, yes, but it also provides so many different tax advantages. Right? So you not only get an asset, you not only get cash flow, but you also get a tax deduction at the same time. Right? And so also like, even when it comes to like 1031 exchange, a lot of people are like, hey, I want to sell this property, but when I sell this property, I don't want to be taxed. So you have tax avoidance, meaning that you're trying to figure out a strategy not to pay taxes at all, or you have tax deferral, which is also really, really important. So with tax deferral for a 1031 exchange, all that is saying, hey, when you sell this property, you cannot touch the money. You have to identify a property within 45 days. You have to sell the property within 180 days, right? So that means you need to work with somebody that's really efficient. But you get to invest in a property of equal or greater value. And guess what you don't have to do? You don't have to pay taxes on that money at that moment. Right? So I want you guys to just understand how important that is. I want you guys to understand how important that is. All right. So that is, and if you guys are like, hey, I want to work with your firm, my accountant is not telling me any of this, or, it's time for me a new accountant, I don't have a good accountant, there is a link in the chat. So Belinda, I see you have a question. And hi, Belinda.
Hi, you just answered my question. I wanted to know if you would possibly be taking on new clients.
Yes. Yep, you can click the link and schedule some time right inside of the in the chat.
Okay, and thank you for all of this information has been very helpful. Thank you.
You're welcome. You are welcome. Marjorie said, in your example of investing in real estate using personal name or LLC versus a fund, can you share more of the difference in tax benefits in these scenarios? So what I was explaining is that there are no differences. It's just a matter of most of the time, if you're invested in a fund, most times those entities are partnerships or LLCs. Keep in mind, guys, whether you invest in real estate personally or you invest in it through an LLC or a partnership, you can write off the same amount of things. So it doesn't change. Okay. It's just about how you file your taxes. And so one thing that I always tell people is you have to just be mindful when you are like registering businesses and things, because all that does is that also tells the IRS which tax documents to look out for you for, right? What taxes are due? How are they requiring you to file? So in an example, and let me just share my screen really quick. I wish I had the other example of a K1. I was trying to get into my tax software, but I haven't been in there in like a few weeks and it takes like hours to upload. I was like, okay, I'm not getting in there. But guys, so what happens is, and I'll just give this example. So you guys see on the left-hand side where it says, hold on one second, because I just want to identify you. All right, so you guys see on this 1040 on the left-hand side, this is an example of someone investing in real estate through their personal name, investing, they didn't invest through a fund, they're just investing in real estate. And let's say they have this loss. the loss would have carried over. You see how that 16,000 that I have highlighted, negative $16,045 was brung over to this to this 1040. And it's just in the additional income from Schedule 1 line item on line 8. If you were investing through a fund and you received a K-1, so you would not be able to file your personal taxes until the fund had issued you, or the LLC had issued you a K-1, what will happen is that K-1 needs to be put inside of your taxes. But that K-1 will also sit on the additional income from Schedule 1 line. So you would have the same negative $16,045, same exact place. It just came in a different way. But in terms of the actual, losses, it's no different in terms of what you can take when you are like reporting through a fund versus your personal. Chantel, you can unmute yourself and ask your question.
Yeah, so just to go back from you said, I think you said this in the beginning, you said that Ashley's first deduction was $23,000. Can you just quickly remind me of how she got the $23,000? I know she was getting an income of $20,000 annually, but how did the deduction of the $23,000, in addition to the building being deducted as well?
Yeah, so those are the operational expenses. So those are the utilities, the mortgage interest, the closing costs, the realtor fees. That's pretty much the operational costs.
Oh, okay. Thanks. Thanks a lot.
You're welcome. Ebony said, what happens with the sum of the depreciation over the years when you sell the property, assuming no 1031 exchange? Love the question. So guys, depreciation is mandatory to take. Most people think that depreciation is this magical tool that the IRS wants to keep from you, but realistically, it's not. What the IRS says is that you have to take depreciation, because when you sell your property, that depreciation has to be added back, and it's called depreciation recapture. So let me just break it down to you, because sometimes when people aren't familiar with accounting, the people who file their taxes totally wrong, and then they're overpaying in taxes by all this money. So let's just talk about what happens when you actually depreciate a property. So we have in accounting what's called, and I try not to use too many accounting terms. So I'm going to try to do this without using many accounting terms. So in accounting, we have what's called book tax, and we have book tax, and we have we have book accounting and we have tax, right? And so sometimes there's a difference between what's on your books and what you file on your taxes. And why? Because your books is going to be your actual deductions that you actually wrote off, right? What the real life things are happening. What's happening on your taxes, which I told you guys when it comes to depreciation, it doesn't matter, right? How much money you put down. Your depreciation expense is based on how much money you paid. Your depreciation is based on the value of your asset. Okay, so we're clear there, right? Depreciation is based on the value of your asset. So because depreciation is based on the value of your asset, what happens is every time you take depreciation on the tax side, so let's just say the property was $500,000, right? Every time we took depreciation, so let's say we took that $76,000 depreciation, what happens is that we get to reduce we have to reduce that $76,000 value from the $500,000. So every time we take depreciation expense, every single year, we just keep adding. Every time we take depreciation, we add the amount that we deduct the amount that we took on our books. And the reason why you have to do that is because at some point your book and your tax have to agree. Now, what happens when you file your taxes and there is depreciation recapture, all that means is that you have now taken your value of your asset all the way down because you've taken all of the depreciation. In order to show a whole number in terms of when you sell a property, what do you need to account for? You need to account for the cost that you purchased it at and what you're selling it at, right? That's going to determine your gain. In order to get your value back up to where it should be, you have to recapture all of that depreciation. Basically, you just need to add all the depreciation back. So let's just say hypothetically, we'll just use the 76,000. Let's just say with the $76,000, we reduced it. So now that means that our value would be $524,000, right? So $424,000, that's what the value of the property is. But when it's time for us to sell it, we need to show that the original value of that property is really $500,000. Right? So basically what we would do is we would add back the $76,000, which is called depreciation recapture. And then let's say we sold the property for, let's say we sold it for $750,000. Then what happens is now we reduce the 500,000 from the 750,000, which would then get us a profit of 250,000. Okay, so that's pretty much what happens when you depreciate. You do have to depreciate, you do have to add it back, and that's how you come up with your correct depreciation your correct capital gains amount that you sold the property for. All right. So I hope you guys followed that. I tried to make it as clear as possible, as it relates to depreciation and selling your property. But depreciation is amazing. We all should be, we are required to take advantage of it. So if you have real estate or, let's say you've invested and somebody is not taking advantage of real estate, we need to make sure that that gets done ASAP. Are there any additional questions?
Well, y'all give it up for Shaquanna, Miss Business 101, my fellow Beehive girl. Oh my goodness, that I've never met anybody who made taxes fun. Usually it's boring, it's dreadful, it's stressful. And you made it, you added some zhuzh to it. And now folks probably like, you know what, we about to switch our CPA because she seemed like she more fun.
Listen, we're fun over there. We're fun. We're hand holders. We're gonna make sure you're good. And just being able to have someone to actually implement these things, because a lot of times you hear things and it's like, well, who's gonna help me with this?
Right. And make sure y'all follow her. She's on Instagram, Miss Business 101. She has a live webinar, free webinar every Thursday night, right?
Yep.
Every Thursday night she goes live. So make sure you join her. Make sure you follow her. I put the link in the chat. See, shucks. Wait a minute, Venus. Venus said her CPA ain't tell her none of that.
Every time I'm in these classes, they're like, my CPA never told me this. So I asked my CPA what was an alternative and they told me nothing. You have to be mindful, especially as you all grow, that you have to understand, one, it's okay to fire whoever is no longer serving you. It's just life. It's how it goes. It really comes down to it's either you or them. Right?
Yeah. So it's some deals. It's some deals on Vestor. It's some real estate opportunities where folks can invest in to take advantage before December 31st. Like she said, you can't, once January 1st hit, it's too late, but you still got time. It's still an opportunity. So I put the link in her chat. I'll put it in the chat again if you want to book a call with her team. Because a lot of the questions that I receive, Shaquanna, should I use my self-directed IRA or my EQRP to invest? And I'm like, okay, that is definitely a question for your CPA. So get into those complicated, scenarios on which will be but it's good to talk to someone, like you, a CPA who can give you the best answer. So that way, in the long run, when a tax bill come, they may not get one or may not be as big. So, folks like Tommy who keep buying real estate, so they bill, I'll put you on the spot, Tommy, but, or keep investing in real estate. It's some other folks on the line too, that just invest in real estate, like myself. We just trying to find ways to help. I mean, me too. We were literally just talking about this, like, man, we got to buy more real estate. We got to buy more real estate because that'll help us with our tax bill and we don't have to pay so much. So yes, so put the link in the chat. Make sure you connect with her. It's still time. You want to get on the calendar. It's hard to get on. I'm gonna tell you this right now from experience. It is hard to get on a CPA calendar. January 31st through April 15th. So you need to get on her calendar now. Am I right?
Yes, this will be the perfect time.
Yep.
This will be the perfect time because what we do at Brooks Alliance is we prioritize clients. You guys are coming in now, so I'm going to honor you guys. But typically what we do, starting in December, late November, early December, we start onboarding our existing clients, and we typically don't open up we don't allow new clients in typically until about February, March, but sometimes I will just say, nope, we have enough going on with our current clients. I've done that 2 years in a row because my goal is to make sure that I'm consistently serving who's there versus just bringing people in, right? So now would be an ideal time just to, start getting the conversation started and getting, just understanding if we're a good fit and, just understanding our process. So it's definitely a detailed process. Like we review taxes on a video call with you. We walk through your taxes line by line. So you see how I just pulled up a tax return? Most of you have never been walked through your tax return. You don't understand what's happening. If you're getting a refund, why? If you owe, why? So we do walk you through your taxes to just make sure that you understand, because I can't help. I like to brag. I like to be like, listen, this person saved a lot of money, but I can't do that if you guys don't understand the basic concepts of taxes and how it all works. Once you guys understand that, then as you're moving throughout your day, you can now help me help you. All right. So this was amazing. Thank you so much for having me. And you all have an amazing, amazing night. I'm actually going to go jump into one of my community classes. I guess it's still going on.
Oh, well, we'll let you go. And the folks who paid for the upgraded VIP, you should have received the link, and we'll jump on there if you still have more questions. And thank you so much, Shaquanna, and we will see you.
Anytime. Once everybody invests, let me know and I'm there.
Okay, we'll have it. All right. Y'all have a good night. Thank you. Thank you all.